Hi, my name is Sidharrth Shankar and I'm a partner with JSA. Welcome to this podcast. Today we're going to have a quick discussion on the Indian insurance sector, recent developments, and the road ahead. In November 2024, the Ministry of Finance, in consultation with the IRDAI, issued a memorandum proposing amendments to overhaul the insurance regulatory framework. The proposed amendments focus on ease of doing business, enhancing insurance penetration to achieve the goal of insurance for all by 2047. The government also invited comments from external stakeholders to the proposed amendments to the legislative framework.
In continuation with the government's proposal, the finance minister in the budget speech proposed to increase the FDI limits for insurance companies from 74% to 100%. The enhanced limit will be available for insurance companies which invest the entire premium in India, and it is also expected that the current guardrails and conditionalities associated with foreign investment will be reviewed and simplified. The finance minister also stated that specific benefits to insurance offices of global companies which are set up in IFSC will be proposed. The amended bill to the Insurance Act 1938 and the Allied Acts is expected to be tabled in the current session.
FDI in insurance companies currently permitted to 74%. Insurance companies with any foreign investment are required to have majority of its directors and key managerial personnel as resident Indian citizens. Interestingly, insurance companies with more than 49% FDI are required to have 1. At least 50% of its directors to be independent directors, subject to certain exceptions, and 2. At least 50% of the net profit of the financial year to be retained in general reserve if A. dividend is paid in the said financial year, and B. solvency margin is less than 1.2 times of the control level of the solvency. It is expected that the proposed increase in FDI limit to 100%, the existing conditionalities to FDI will be simplified, including in relation to residency status of directors and key managerial persons. Under erstwhile insurance laws, a cooling off period of 2 financial years was prescribed to apply for registration of an insurance company if the Indian promoter or the foreign investor had exited an insurance venture. Currently, there is no such restriction, and promoters, including foreign promoters, can exit a joint venture and immediately apply for registration of an insurance company with 100% FDI.
Currently, insurance companies can undertake life, general, standalone health insurance business under separate legal entities, which requires the promoters to form separate entities and diversify their assets. It is proposed that insurance companies can obtain a composite license under which life, general, and health insurance business can be undertaken under one unified entity. This proposal aligns with the global practices in many jurisdictions and could lead to consolidation of existing ventures in the Indian insurance market. The Insurance Act prohibits a merger of or transfer of insurance business of an insurance company with a non-insurance company. This restriction was much debated in 2015 on the proposed merger of HDFC Life and Max Life. The said transaction involved an intermittent step of merger of Max Life with its listed holding company Max Financial Services, and thereafter merger of the combined entity with HDFC Life. After much debate, the transaction was rejected by the IRDAI on the technicality that the Insurance Act permits a merger between 2 insurance companies of the same class. It is now proposed that insurance companies can merge and transfer insurance business to a company not engaged in insurance business. If implemented, this proposal could lead to innovative structures in the market where exits could be provided to investors investing in the promoter of an insurance company. Also, non-insurance companies could achieve backdoor license to undertake insurance business in India.
The government has also proposed reduced capital requirements for insurance companies that serve undeserved segments, insurance companies to undertake incidental business other than insurance business, prior approval of IRDAI for transfer or issuance of shares exceeding 5% of the share capital as opposed to 1% of the share capital, inclusion of managing general agents as an insurance intermediary to provide customized insurance solutions. In conclusion, reduced compliance burden, lower capital requirements, simplified process, and effective and efficient implementation of such processes are key to transforming the insurance sector. Thank you.